Hello and welcome back to Fast Track Finance with Bronte. Today we are going to be going through one of my biggest love-hate relationship interview questions, which is the Paper LBO. And the reason I love/hate this was I had this come up in a Goldman interview when I was actually moving from credit into equity, and I completely messed it up. I'd never heard of a Paper LBO before. And I think the interviewer actually apologised about how painful the interview was. Needless to say, I did not get the role, and therefore I think it's important we spend time making sure that you do not turn up as unprepared to an interview as I was in that instance. So the Paper LBO is a simple way for your interviewer to understand if the candidate understands the basic mechanics of a leveraged buyout model. Typically, you'll be given pretty basic assumptions, and if you're lucky, you may be given a calculator. If not, typically the interviewer will give you relatively simple mental math assumptions so you can make the transaction work. If you look on the screen now, I will put an example of potential transaction parameters, and my advice is at this point you pause, look at the potential questions, and have a go at doing this yourself. In the next step, we will walk through what to do. So you can see that we started out with some transaction assumptions. These include the entry revenue, the entry EBITDA, an entry multiple, and also a gross leverage multiple, which you'll be applying to the business. The next step is to work out your financials forecast. So you're given the entry level and you're given some operational assumptions such as the revenue growth, the gross margins from which you can back out COGS, and also the EBITDA margin so you can back out the operating expenses. So starting with year one for revenue, it would be a simple equation of just taking the entry revenue, timesing that by 1 plus the gross rate, and expanding that across the forecast period for the 5 years. Then you would work out your gross profit by timesing the revenue by the gross profit margin. And then you could work out your COGS by essentially taking the gross profit and taking away the revenue, so you'll end up with a negative figure. In a similar way, you'll do the exact same for the EBITDA margin. So you'll take the revenue for that year, you'll times it by the EBITDA margin, and then you can back out your operating costs, which would typically include SG&A and R&D, by taking the EBITDA and taking away the gross profit to give you your operating expense line. Next, we will end up with EBITDA. And from EBITDA, we need to calculate EBIT, which means we need to deduct depreciation and amortization. Now we've got EBIT, we need to work out what our interest cost is. Now this requires a little bit more thought. So if we look at the transaction structure and we begin with 10 million of EBITDA and we're going to apply 5 times of leverage, that means we start out with entry debt of 50. Now if we apply a 5% coupon to that debt, which is the interest that you will have to pay every year on the debt on which you are borrowing, that equates to 2.5 million that you're paying in interest per year. Now that you've got your interest, you can deduct that from your EBIT. You end up with your profit before tax. You can take away your tax rate by timesing the profit before tax by the tax rate, and then you end up with your net income. At this point, we need to reverse some of the non-cash charges and also take away the cash charges to end up with our free cash flow that we're generating every year. So we'll begin by adding back depreciation and amortization because that is a non-cash charge. And then we need to deduct by CapEx, which is typically given as a percentage of revenue. And in this example, I've made it equal to the percentage that you're also taking of D&A, depreciation and amortization. So they essentially net out to 0. And then we also need to deduct our delta, our change in working capital every year. Now this ends with our ending free cash flow. Once we've done that, we can essentially calculate the sum of cash that we are creating or the business is generating over the whole period. And what we will do is we will reduce the entry net debt by the cash that we are generating throughout the holding period, because we are assuming that we are going to pay down we're going to use our free cash flow to pay down all of our debt and not use it for any other purposes. So now that we get to our kind of ending cash flow figure in year 5, which is the whole period we'd assume for this particular transaction, we can calculate the exit assumptions. So we will begin by essentially understanding what our exit multiple will be, and then we need to apply that to our ending year EBITDA. Multiplying those together will give us our ending enterprise value, and then what we need to do is deduct the ending net debt. And as mentioned before, that ending net debt is basically the sum of your entry gross debt, take away all of the cash in which you have generated over that whole period, and that bridges us down to our ending equity value. And then in order to calculate the returns, what we do is we essentially divide our ending equity value by our entry equity value, which gives us our multiple of cost. In this instance, this works out till around 2. Now, the next part is where the real fun begins, because mental arithmetic on IRRs, you just need to know the trick. So essentially, in this example, if you generate a 2x MOC over a 5-year hold period, this is essentially equivalent to making 100% IRR over 5 years. So what you need to do is divide the 100% IRR by 5, which gives you 20. But because of the compounding effect of an internal rate of return calculation, you actually need to apply a slight deduction to that 20%, which is around 0.75 or between 0.6 and 0.7, which takes us to around a 15% IRR when you generate 2 times your money in 5 years. Now, some of the other questions the interviewer might ask you are, could you please calculate the entry equity value? And that would also be quite simple. You basically begin with your entry EBITDA, your entry multiple, which you're applying that to, that will give you your entry enterprise value, and then you would deduct your entry net debt, which is the debt that you start out with, any cash which is on balance sheet, and that will bridge you to your entry equity value. And we've already discussed how you would generate or calculate the cash that you have generated over the whole period, and that will allow you to calculate your ending net debt. And then we've just gone through how you would calculate your IRR and MOC. I hope that clears it up, and I think it's important not to stress. It's actually quite simple if you just go through this a couple of times, even record yourself like I am now to make sure you fully understand and you can present that to an interviewer. They might ask you some follow-on questions such as, what happens if there was a PIK structure on the debt? Now, what that would mean is that not all of the cash which is currently coming out as an interest cost would be flowing through the P&L in the same way. So you might have a cash coupon and a PIK coupon components of your debt. And what you would do is exactly what we've done for the cash coupon, you would do the same because we've assumed it's all cash in this example. But if there was a more complex example, such as PIK, you might assume that maybe instead of 5% of your interest as cash, 2.5% that could be as PIK. And essentially what that is you are not paying that in cash every year to the lender in which you've borrowed the money from. You are actually accruing that amount of interest onto the principal balance every single year. So it grows by the 2.5% of the initial debt, which will be 1.25 every single year. And essentially that means that you have a higher ending net debt. So in this example, it would be 1.25 times 5 added on to your entry net debt to find your exit net debt. And one of the reasons they might do that, as you can see from this example, is that you're putting a lower cash burden onto the company. And if it was a company that had low margins, perhaps it was subject to cyclicality because of the sector that it was in, these might be some ways in which you can reduce the cash burden on the company. They could also ask you questions about amortization structures. We've assumed that the debt is a single tranche and that it is a bullet, i.e. there is no amortization over the period. But you can also have structures such as 5% amortization of the original principal every year that you have to pay back on a term loan, for example. Or you may even have a cash sweep, which says that all of the cash that you generate pays down debt, which is essentially what we have done in this model anyway. So I really hope that answers your questions, and if you have any further ones, please feel free to put them in the comments, or if you have any suggestions for future videos, please do let me know and I'll be happy to help.